Welcome everyone. Today we're delving into the fundamental aspects of investing, stocks versus bonds. Understanding the differences between these two asset classes is essential for building a well-rounded investment portfolio and achieving your financial goals. Let's start with stocks. When you invest in stocks, you're essentially buying ownership stakes in companies. As a shareholder, you participate in the company's growth and profitability. Stocks are known for their potential to deliver high returns over the long term, but they also come with higher volatility and risk. The stock market is influenced by various factors such as economic conditions, company performance, industry trends, and investor sentiment. Prices fluctuate based on supply and demand dynamics, making stock investments more unpredictable in the short term. Investing in stocks requires thorough research and analysis to identify companies with strong fundamentals, competitive advantages, and growth potential. It's essential to diversify your stock portfolio across different industries and market sectors to mitigate a risk and capture opportunities for growth. On the other hand, bonds represent debt securities issued by governments, municipalities, or corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of the principal amount at maturity. Bonds are typically considered safer investments compared to stocks because they offer more predictable returns and lower volatility. Bonds are characterized by their fixed income stream, maturity date, and credit quality. They provide investors with steady cash flow and serve as a hedge against stock market volatility. However, bond prices can still fluctuate based on changes in interest rates and credit risk perceptions. Now, let's explore some key differences between stocks and bonds. Investors often weigh the trade-offs between risk and return when considering stocks versus bonds. Stocks generally promise higher potential returns, particularly in high-growth sectors like technology, but they also expose investors to greater volatility driven by market uncertainties and regulatory changes. On the other hand, bonds, particularly government bonds like U.S. Treasury bonds, offer lower returns compared to stocks. However, they provide a safer investment option, ensuring stability and the safety of principal through guaranteed interest payments and repayment of principal at maturity. Understanding these dynamics helps investors make informed decisions based on their risk tolerance and investment objectives. Investment decisions often hinge on the balance between income and growth potential, particularly when comparing bonds to stocks. Bonds are renowned for their income-generating capabilities, offering investors regular interest payments in the form of coupon payments. Corporate bonds, particularly those issued by established companies, provide a reliable stream of income through these regular coupon payments, making them appealing options for retirees seeking stable cash flow. Conversely, stocks present investors with the opportunity for both income and growth. Dividend-paying stocks, especially those of established utility companies, offer investors a combination of regular income through dividend payments and the potential for capital appreciation as the company's earnings grow over time. Understanding these distinctions allows investors to align their investment strategies with their financial objectives and risk tolerance levels effectively. Diversification is a cornerstone of sound investment strategy, involving the allocation of investments across different asset classes to mitigate risk. Both stocks and bonds play crucial roles in building a diversified portfolio due to their distinct characteristics and behaviors in various market conditions. Stocks offer investors the opportunity to diversify across different sectors such as technology, healthcare, and consumer goods. By spreading investments across diverse sectors, investors can reduce exposure to sector-specific risks and capture opportunities for growth, even if one sector experiences a downturn. Similarly, bonds provide avenues for diversification across various types, including government, municipal, and corporate bonds. Diversifying across different types of bonds helps investors mitigate credit risk and interest rate fluctuations in the bond market, enhancing overall portfolio stability. Understanding the benefits of diversification across stocks and bonds empowers investors to construct resilient portfolios capable of weathering market fluctuations and achieving long-term financial objectives. Your investment time horizon significantly influences the allocation between stocks and bonds within your portfolio. Stocks and bonds serve distinct purposes based on investors' time frames and risk tolerance levels. For long-term investors willing to withstand market fluctuations, stocks offer the potential for significant growth over time. Growth-oriented stocks of emerging companies, held for 10 years or more, provide ample opportunity for substantial returns despite short-term market volatility. Conversely, bonds are favored by investors seeking income and capital preservation in the short to medium term. Short-term government bonds, with maturities ranging from 1 to 3 years, are ideal for investors prioritizing capital preservation and liquidity while earning a modest yield on their investments. Understanding the alignment between your investment horizon and asset allocation allows you to optimize your portfolio for long-term growth and stability, ensuring your investment strategy remains well-suited to your financial objectives and risk tolerance levels. The dynamics of the market influence both stocks and bonds, albeit through different mechanisms. Understanding these dynamics is key to making informed investment decisions in both asset classes. Stock prices are primarily driven by company-specific factors and overall market sentiment. Events such as product launches, mergers, or earnings reports can significantly impact stock prices, reflecting investor perceptions of the company's growth prospects and financial health. Conversely, bond prices are more sensitive to changes in interest rates and credit quality. Factors such as central bank policies, economic indicators, and geopolitical events can influence interest rates and credit spreads, impacting bond prices and yields across different maturities and credit ratings. By recognizing the distinct influences on stock and bond prices, investors can adapt their strategies to navigate market fluctuations effectively and capitalize on opportunities for long-term portfolio growth and stability. In summary, understanding the basics of investing in stocks versus bonds is essential for building a balanced and resilient investment portfolio. Both asset classes have their unique characteristics, risks, and potential rewards. By diversifying across stocks and bonds based on your financial goals, risk tolerance, and investment horizon, you can optimize your portfolio for long-term growth and stability. Thank you for joining us on this insightful exploration of investing in stocks versus bonds. If you found this information valuable and would like to see more content like this, please consider subscribing to our channel. Don't forget to give this video a thumbs up if you enjoyed it. Your support helps us continue to provide valuable insights to our community. Thank you.